Where is the smart money going right now? It's not always in the obvious places, and it's rarely about chasing hype. In 2026, the most successful investors are focusing on long-term trends, strong assets, and opportunities most people overlook. From the rapid rise of AI-driven companies to steady income investments and global diversification, smart investors are positioning themselves ahead of the curve. They're not just trying to make quick profits, they're building systems that grow wealth over time. Today, we will talk about where smart people invest their money. Now, so before we get started, make sure to hit that like button, also subscribe to my channel. 10. High-yield cash and short-term investments. The first place smart investors put their money is in safe, liquid investments like high-yield savings accounts, certificates of deposit, CDs, and short-term government or corporate bonds. Even though these options don't offer huge returns, they have two major advantages: security and liquidity. You know exactly what your money is doing, and it's available if a better opportunity comes along. For example, imagine you have $10,000 sitting in a regular savings account earning almost nothing. Inflation erodes that money's buying power every year. Now imagine putting the same money in a high-yield savings account or a short-term bond yielding 4–5% annually. That money grows while still being safe. 9. Dividend and stable income stocks. Next, smart investors often put money into companies that generate steady income through dividends. Instead of focusing solely on rapid growth, they invest in businesses that have consistent profits and pay regular dividends. These companies tend to be stable and reliable, even when the market is volatile. For example, utility companies, consumer staples, and certain large tech firms often pay dividends regularly. If the stock price dips, you still earn money from dividends, which helps offset losses. The advantage is twofold: a steady income stream and potential capital appreciation. This approach creates financial stability and reduces reliance on risky bets. 8. Artificial intelligence and technology. One of the fastest-growing investment areas today is artificial intelligence and technology. Major corporations are investing billions into AI, automation, cloud computing, and related technologies. Smart investors are following this trend, but not just blindly. They study the broader ecosystem, including software, hardware, infrastructure, and data services. For example, instead of only buying the stock of a popular AI company, they might invest in companies that build AI chips, cloud servers, or AI software tools. That way, they benefit from the entire industry's growth. This approach spreads risk and maximizes potential returns. AI isn't just a trend, it's a structural shift that will shape multiple industries for decades. 7. Index funds and broad market investments. Smart people also focus on low-cost index funds and ETFs that track the broader market. Instead of trying to pick individual stocks, they invest in the overall market. This strategy reduces risk and ensures consistent growth over the long term. For instance, investing in an S&P 500 index fund means you benefit from the growth of the 500 largest companies in the U.S. without needing to predict winners and losers. Historically, broad market investments have outperformed most individual stock pickers over long periods. 6. International and global markets diversification is a key principle of smart investing. That's why many investors don't limit themselves to their home country, they invest globally. Different countries and regions experience growth at different times. Emerging markets, for example, often offer faster growth than developed economies, though with slightly higher risk. By investing in international stocks or global ETFs, smart investors can capture growth from multiple regions. This strategy also protects their portfolio from local economic downturns or political events. Global exposure helps balance risk and maximize opportunity over time. 5. Alternative assets like cryptocurrency. A smaller portion of money often goes into alternative assets like cryptocurrencies or blockchain-related investments. These assets are highly volatile, but smart investors allocate only a fraction of their portfolio here. They understand the risks and potential rewards. For example, Bitcoin and Ethereum have historically shown strong growth potential, but they are unpredictable. By limiting exposure and using disciplined strategies, investors can participate in potential gains without risking their entire portfolio. The key is careful allocation, research, and risk management. 4. Real assets and infrastructure. Smart money is also flowing into real-world assets, including infrastructure, energy, and real estate-related investments. Why? Because these areas are essential for economic growth. Data centers, energy grids, transportation, and commercial properties all have consistent demand. Investing here isn't flashy, but it's reliable. Infrastructure tends to be less volatile than the stock market, and it often benefits from long-term economic trends. For instance, as technology companies expand, the demand for energy and data storage grows. Smart investors position themselves to benefit from these underlying trends. 3. Skills and personal growth. One of the most overlooked investments is investing in yourself. Even the smartest investors know that the best returns often come from personal growth. Learning new skills, adapting to emerging technologies, or improving business and financial knowledge increases earning potential in ways that no traditional investment can match. For example, mastering digital marketing or coding can allow you to start a profitable business, freelance, or take advantage of opportunities others miss. Investing in yourself is scalable and permanent. Skills don't depreciate like money, and their value compounds over time. 2. Diversified portfolios. Smart investors rarely put all their money in one asset or sector. Instead, they create diversified portfolios across different asset classes: stocks, bonds, cash, alternative investments, and international markets. This approach spreads risk and reduces the chance that one loss will devastate their finances. If one investment underperforms, another can balance it out. Diversification doesn't eliminate risk completely, but it makes wealth growth more predictable and resilient. 1. Long-term ownership in growing industries. Finally, the most important strategy is long-term ownership in industries with strong future growth. Rather than chasing short-term trends or hype, smart people identify sectors likely to expand over the next decade or more: technology, AI, renewable energy, healthcare, and global infrastructure. They invest early, hold steadily, and benefit from compounding growth. This strategy reduces stress because they aren't reacting to short-term market swings, they are focused on the long-term potential. This is the type of investing that builds real wealth over time. It's not about luck. It's about strategy, research, and patience. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.